Hello, I'm Vuyo Mroxiso, a manager in the product development team at Allan Gray, and today I'm joined by two of our portfolio managers, Shaun Munsie and Thalia Petousis, as well as the head of product development, Shaun Duddy, to discuss our newly launched funds, the Allan Gray Interest Fund and the Allan Gray Income Fund. Welcome to you all. At Allan Gray, we've maintained that we aim to keep our fund range focused. We only introduce new offerings after careful consideration and where we believe the additions will better help our clients meet their goals and objectives. So Shaun Duddy, can you please take us through some of the primary considerations and motivations behind launching the Allan Gray Interest and Income Funds?
Whenever we're considering the launch of a new fund or funds, we always ask ourselves 4 questions. Number 1 is there a client need? In other words, if we add the new fund or funds, will clients be able to derive real value from that addition? Number 2, can we ourselves offer a compelling proposition for that fund or funds? In other words, can we do a great job for our clients, both in absolute terms, but also in relative terms in comparison to what might already be available out in the market? Number 3 is, if we do this, can we still protect our ability to offer great performance to our existing clients in our existing funds? And then lastly, is the timing for the launch of these funds opportune? Does it make sense to do so? Now, when we were thinking specifically in the context of the interest and income funds, some additional context to keep in mind was over recent years in the South African market, we'd seen a notable shift in demand for portfolios that have very little or no equity exposure. Now, part of that's definitely cyclical because we've seen a risk-off environment, low investment returns from South African equities in general, but we also believe that there are structural elements to that shift, right? So both financial advisors and portfolio constructors or aggregators have increasingly been using building block funds like local interest funds, local income funds, etc., to construct their own multi-asset portfolios. And then on the other hand, investors themselves have increasingly been using bucketing type approaches in their retirement investments, specifically post-retirement, where they're using different types of funds for different durations. And these kind of fixed income or fixed interest funds form a core component for generating income and drawing that income post-retirement. So it's within all of that context that we have chosen to launch the interest and income funds. And we believe the funds will offer a compelling option for investors that are looking for a lower risk income generating portfolio that generates returns higher than what you get from typically investing in a bank deposit or a traditional money market fund, but still has low volatility and maintains a high degree of capital stability.
Sure. Thanks, Shaun. Thanks for that comprehensive answer. Thalia, as a co-manager of the funds along with Shaun Munsie, please explain the investment mandates and the objectives of the funds. It would be useful to also touch on what assets these funds can invest in.
Okay, well, the Allan Gray Interest Fund, it's actually quite similar to the Allan Gray Money Market Fund in that it's 100% domestic-only interest-bearing assets. We can just take on slightly more modified duration than what we can in the Allan Gray Money Market Fund, and we can invest in slightly longer dated instruments. So again, we expect to have higher returns in the Allan Gray Interest Fund versus the Money Market Fund over time. Now, the Allan Gray Income Fund, we also are allowed to allocate towards equities and property. But again, in the interest of maintaining a low volatility, we expect to only do that at extreme points in the valuation cycle. So to date, we actually haven't taken any equity or property exposure in the Allan Gray Income Fund. Now, in that fund, we can also take on slightly more modified duration than in the Allan Gray Interest Fund. And again, hopefully we'll achieve slightly higher returns. So the modified duration band that we've had in the Allan Gray Income Fund to date has been between 0.8 and 1.8 versus the Allan Gray Interest Fund, which is oscillated between 0.5 and 0.8. And then in the Allan Gray Income Fund, we can also allocate towards offshore fixed interest assets. And we've set an internal limit of a maximum of 20% of fund. But in practice, we're also very mindful of the volatility around offshore assets as well. So to date, the most that we've had in offshore assets in that fund has been 10% of fund, and we actually hedge that position back to rands.
Thalia, can you talk us through the target returns of each of these funds?
So the benchmark for the funds is Steffi Composite, but I mean, we're aiming to do much better than Steffi Composite in actuality. Sure. So right now, I'd say the target return for the interest fund is about cash plus 1.4%, and the weighted average yield is there at the moment. And then, occasionally we'll get a bit of a boost also from capital gains at different points in the cycle. And then for the income fund, it's obviously a slightly higher target return with a slightly higher modified duration. So there we're hoping for anything between cash plus 1.5% to cash plus 2%. And right now we're at cash plus 1.7%.
Shaun Duddy, over to you again. Please, will you describe the fund fees?
As is the case with our existing fixed interest funds, in other words, the Allan Gray Money Market Fund and Bond Fund, both the interest and income fund are going to have fixed percentage investment management fees. Now at Allan Gray, we are very strong proponents of performance fees, but in cases like these where the funds are very unlikely to experience extreme outperformance and potentially more importantly, extreme underperformance, we think it is far more appropriate to have the simplicity of a fixed fee in place. And so both of these funds will do exactly that.
Where do the new funds fit into Allan Gray's overall fixed income fund offering?
Well, in the context of expected risk of capital loss versus expected return potential, both the interest and the income funds are going to slot in between our Allan Gray Money Market Fund on the lower end and our Allan Gray Bond Fund on the higher end. For the interest fund, as we've discussed a little bit already, the fund is not going to typically take on a lot more credit risk than the money market fund. In actuality, it's typically going to invest with the same types of entities or lend to the same types of entities, but just for longer periods of time in pursuit of higher return. So as Thalia alluded to, that should see us generate returns higher on the one hand than bank deposits, but also from what you'd get from the money market fund. That does come, though, with slightly higher volatility. So the interest fund is more flexible than the money market fund. The income fund, in turn, is more flexible than the interest fund. So it is also allowed to invest for greater duration. It has no duration cap in place. And in addition, it has the optionality to invest in offshore instruments, as we've alluded to. And it also has the ability to invest in equity and property stocks, although we don't typically expect to be holding very much of that, except in kind of extreme cases. But the culmination of that additional flexibility on instruments and duration means that, again, you'd expect higher returns relative to the money market fund and the interest fund. But again, that does come with a little bit more volatility. It is important to note, though, that despite all of the flexibility within that portfolio, we are going to be managing it in a more risk-averse or conservative way relative to the bond fund. So it won't surpass, it's not expected to surpass the bond fund on a risk or return basis. So they slot in the middle there.
Thanks, Shaun Duddy. We've spoken at length about our fixed income offering. Where does the stable fund fit in?
A key difference for the stable fund is that it's not a fixed interest fund only. It's a low equity multi-asset fund. It will hold equities more consistently over time in the region of 20 to 40%. So that's a key differentiator. And it also typically holds a greater amount in offshore. So just from the way that the fund is constructed and the fact that it is a multi-asset fund rather than just a fixed interest fund, that's a key difference. As a result of those compositional differences, again, you'd also expect a higher rate of return over time from the stable fund relative to the income fund, for example. And with that, you'd also expect a little bit more volatility. But I guess a very important point to highlight is that the stable fund is our flagship, lower risk multi-asset fund, and where investors are looking to trust us with the asset allocation decisions, that is the appropriate fund for them.
After listening to Shaun Duddy's explanation of where the funds fit into our fixed income range, it would be useful to better understand the nuances which were touched on between the Allan Gray Money Market Fund and the Allan Gray Interest Fund. So can you please explain the main differences between these two funds?
The money market category in South Africa is a very popular category, and it typically an investor who's got a short-term horizon, let's say up to a year, that is wanting to invest in the market or looking for a sort of a parking place for cash, can be attracted to this type of category. There are drawbacks, though, to investing in the money market category, given the rules that are imposed on a money market fund in terms of the duration or length of instruments that can be invested in. So the interest fund, I guess, tries to take advantage of this and typically would lend to similar or the same entities that a money market fund would lend to. So we wouldn't be taking on any additional credit risk that a money market fund would, but we do earn some additional yield, and that leads to a better return for our clients.
I believe our viewers have a clearer idea of how to differentiate between the Allan Gray fixed income funds. However, I'd like to spend a bit more time on the Allan Gray Income Fund. The multi-asset income category is not homogeneous. There's a wide range of funds in this category with very different strategies. This is somewhat by design, as fund managers are allowed to access multiple asset classes and manage portfolios with varying maturities and durations to achieve their return objectives. Some players are running very conservative mandates with significant exposure to vanilla instruments. And on the other end of the spectrum, we have the more racier players with material exposure to excessively structured and often illiquid debt instruments. So Shaun Munsie, where in this range would you place our income fund?
I think you're right that there's a lot greater awareness on the differences of funds within this category. And as you said, it's a very broad category. I think we're looking to position the Allan Gray Income Fund as a prudently managed fund within this space. And that would typically be rooted in our sort of valuation-focused investment philosophy. You would hope to see come through in the range of instruments in which the fund invests. So typically, we would think in comparison to the market, our fund may have a slightly higher floating rate note component, similarly a decent allocation towards money market instruments. And we would place a sensible limit on the amount of structured products that we would use in the fund, such as credit-linked notes. And credit-linked notes that we do enter into, we would look to limit the amount of structuring within that, say in terms of embedded derivatives. So for us, I guess the transparency in terms of pricing is key here, and the returns on offer to the client and how sustainable those returns within the fund are. So all pricing would be done on a mark-to-market basis daily.
Given the objectives of the funds and how Shaun Munsie and Thalia intend to manage these funds, Shaun Duddy, in your view, what type of investor should consider the Allan Gray Interest and Income Funds?
I think I'd summarize it as follows. So for the interest fund, an appropriate investor would be a risk-averse investor that is typically looking to invest for, say, up to 1 year, but is looking for returns that will be better than what they would get from a bank deposit or a money market fund. They could also be looking specifically for monthly income distributions. So that's the one type of investor that it would be appropriate for. On the other hand, it's also very appropriate for investors that are looking to construct their own portfolios and therefore are looking for a low risk, South African only fixed interest building block that has the same characteristics. On the other hand, for the income fund, there you are also looking for, or the typical investor would also be someone who is reasonably risk averse, but is looking for a fund that will generate an income for them at a yield or a return that is higher than what they would get from a money market fund, but also an enhanced cash fund like the interest fund. But they still prize like lower risk and are looking for capital preservation over a 1 to 2 year period. And then again, it's also very appropriate for people that are building their own portfolios, looking for a multi-asset income fund building block. And as Shaun Munsie referenced, specifically one that is managed on the prudent end of the spectrum rather than on the more kind of racy end of the spectrum.
As Shaun Duddy alluded to earlier, the interest-bearing short-term and multi-asset income categories have grown significantly over the last 8 odd years, and there are plenty of fixed income offerings in the market. So Thalia, in your view, why should investors consider Allan Gray and Allan Gray's fixed income offering?
So there are a few reasons actually why I think investors should consider Allan Gray. The first of those is our experience. So within our retail offering, we have 25 years of experience managing fixed income. That would be by our flagship Allan Gray Balanced Fund. But actually on the institutional side, we have a 46-year history of managing fixed interest. So we already have a full in-house research team. We cover the full spectrum of listed fixed interest instruments. And then on top of that, we have the size. So we currently manage just over 146 billion rand of local fixed interest. And size is actually an advantage in the fixed interest space. I get asked about this a lot. It means that you can actually negotiate a much better yield with the banks when you are placing paper with them. It also means that you don't have to wait for a public auction if it's a corporate who you would like to fund. You can approach them, you can do a listed private debt placement because you have the kind of size that makes it very attractive for them. So you don't have to wait for them to come to market publicly. Then in terms of our investment philosophy, we feel our investment philosophy actually marries very well with the interest and income category because we are always trying to minimize downside risk and always trying to avoid taking permanent loss of capital. And you can really see that come through even in the performance on our current fixed interest offerings. More than 50% of our alpha is generated during down markets. So that marries really well with this category. And then also just in terms of our investment process, we leverage off all of the skills of our entire multi-asset team. So we invest in fixed interest with a really holistic mindset, which we think also gives us quite a strategic advantage in this category.
So the interest and income funds were seeded on the 1st of May 2024, a time of heightened political uncertainty and increased market volatility in South Africa. So Thalia, considering the uncertain market environment when these funds were launched and the market expectation for interest rate cuts, how are the funds currently positioned?
Okay, so we're always adjusting the fund position, because we're very active. And I would say, so when the funds first launched, as you alluded to, the market was very weak. There were actually a lot of really nice opportunities to take on some fixed rate exposure. 5-year money market instruments were yielding 10%. Now we can't look at 5-year money market in the money market fund, but in the interest and income fund, yes, we can. For the income fund as well, there were some nice opportunities to look at some structured products that were yielding 12% on the fixed rate side. A lot of those were run quite hard, so we've seen quite a big market rally. So we've actually taken profit on some of those instruments. And right now, I would say the core holdings in both funds are predominantly floating rate instruments. And there's a range of kind of spreads that you earn above cash on those. It can be, across our funds, kind of the range is about cash plus 1.25% to cash plus 3%. And I already touched on the fact that overall the interest fund is yielding cash plus 1.4 at the moment, the income fund cash plus 1.7. So we've adjusted the instrument weights over time as we see, relative attractiveness in each. You mentioned interest rate cuts. The market is certainly pricing for interest rate cuts, to come into play. And, that will naturally mean that the weighted average yields of the funds will come down. But at any point in time, we're trying to invest in the instruments that are going to, give us the highest possible return. So we're adjusting that mix of instruments in the funds. And I'll also mention that, we've got quite a nice buffer at the moment in that the weighted average yields of the funds is in excess of inflation plus 5%. So even if we do come down slightly, relative to cash, we've still got a good buffer. Relative to inflation, we've still got a good buffer. And we're constantly adjusting the weights of the instruments to try to maintain, as competitive an advantage as what we can get.
In closing, Shaun Duddy, what are the key messages that viewers should take away from today?
we've spoken about a lot.
We have.
So distilling it's going to be interesting. But I think there's probably three. So the introduction of our new interest and income funds has allowed us to broaden our fixed interest fund range and offer to investors, financial advisors, and fund constructors two new options on the lower end of the risk spectrum that are very good for building block portfolios. The other key takeaway in terms of what you can expect from the funds is both the interest and the income fund are expected to generate returns in excess of what you would typically expect from a bank deposit or from a money market portfolio, with the income fund sitting above the interest fund, but both of the funds still prioritize the management of risk and capital stability. And then I think the third very important thing to note is that we as Allan Gray are very well positioned to run these portfolios and generate meaningful value for clients. As we've discussed, we have a long and successful history in managing fixed interest, both on a standalone basis and within our multi-asset portfolios. And we really think that we have a competitive advantage that adds a lot of value to clients, in the sense that we manage our fixed interest as part of our holistic investment management approach, rather than doing it in a siloed type of way. And so across all of those kind of key takeaways, we're very excited to introduce these two new funds to our range and to investors.
Thank you to you all for sharing your insights. I think we have a clearer understanding of where the Allan Gray Interest and Income Funds fit into Allan Gray's fixed income range, as well as how investors can use these funds in their portfolios. Thank you for your time.